Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I was scrolling through the comments section, and lots of the time I answer your guys' questions with videos so everybody can hear what I think. It says, Andy, do you ever go into trade size or selling a stock that is not performing well? How long do you hold underperformers? How did you pick the oil and gas stocks you have? So each position size that I put on, and this is in my more aggressive portfolio. So first I'll step back and let you guys know what my portfolio looks like. I'm about 25% physical precious metals, 40% real estate. And that's just my own residential real estate and the equity and all that stuff I have in it. Not equity, it should be the total exposure that I have in it. And then the rest, which is about, let's just say it's about 40%, 40%. Of that 40%, 401k, kind of retirement stuff. Then about 20% in total. So that's 50% of the 40%, which is 20%. That's where I swing for the fences. So I only swing for the fences with 20% of my net worth. In that portfolio, the 20%, I have position sizes ranging from 1% to 5%. Very rarely will I exceed 5% of the total portfolio value in one position. So I'm not over leveraged to one thing. If you think that you can't sleep at night or if something's going wrong, I would pull back that amount of investment in it. So there's times where you can be invested. You think it's underperforming. It may or may not be. And you're sitting there looking at it, and you should have a reason that you bought it. It should be like recaf. I've been cost averaging into that. We went all the way up to $11 and came back down to $3 and something cents here recently. Now it's back up over $5. I rode the entire thing all the way through that, and I still think it's going to do very well. I think it'll beat $11 at some point. I think it'll go far higher. But that's kind of my take on it, and that's how I'm able to hold through all this volatility, is because my position is sized correctly. I'm not over leveraged to any one position, although some of my positions that I originally put in have become enormous because of how big they have grown in value. I still have not taken profits. I think that we are in the early innings of this commodity bull market. I'm talking like this is just getting heated up. Now, I've read some other comments down below. There's some people that think that commodities are going to be in a deflation. I completely disagree with that. But and the reason being, I can go over some of that here in a little bit. How long do you hold underperformers? Now, it depends on how you talk about underperformers. You could say that the gold and silver sector has been underperforming, and I've been holding it the entire time, but it's been underperforming for the past little over a year and a half, somewhere in that range. Does it mean that I sell my stocks? No, they're still of great value. So I chose certain sectors and I chose certain stocks in those sectors because I want exposure to it. So I don't consider them underperformers. I just consider them out of favor at the moment. They'll come back into favor and they're going to do incredibly well. That's my opinion. So if a company is not performing the way that you want it to, if you're not seeing, like, let's say uranium's going up and this company is not going up, sometimes it's worthwhile selling it and putting it into something that you think is a better opportunity. Maybe it's going up, but it's not going up as much as you want. The leverage isn't as great as you thought. I would sell it right there and then swap it to whatever you think is going to perform better. It also depends on how much risk and volatility that you can handle. Risk is something a little bit different than volatility. I don't look at volatility as risk. Risk is, can this company go bankrupt? So I limit my position sizes to a certain amount in case something happens to the companies. How did I pick the oil and gas stocks you have? Well, so the ones that I own that are highly leveraged to the price, they have high debt. They were SM Energy, Centennial Resource Development, Callon Petroleum, QEP was another one that got bought out. Those are some. They were high debt and they got sold off dramatically to the downside. And the way that I chose those companies were more on technical analysis of anything else, because you have to have a company that gets absolutely slaughtered to the downside and then get some pop coming back up. The short sellers were in these companies and they were shorting the heck out of them. They thought they were going to go bankrupt, and I took the opposite bet. And that's how you can get very outsized returns quickly. So I took a calculated bet, and I overweighted SM Energy because I thought that was the best opportunity of any of the oil and gas companies that I could find based off of the technicals. Looking at their balance sheet, I thought they were a risk to go bankrupt, but I didn't think it was that great of a risk. So I thought that was probably the best risk reward of any stock because it got sold off so much to the downside. So I look at the technicals, and I also looked at how the volumes and the buying pressures were buying that company at the bottom. And I'm wondering if I could actually find a chart that I used to have that, let me see if I can find one for you. And I'm just looking at some of my old, I think I have one in trading. No, I don't think I have anything. But you could buy, you saw the big buying pressure, the slow leak off of sellers that came down, and it was like right there, perfect. People were buying it up. The volume was coming back. Everything looked great on it. The valuations of the gold to oil ratio was over 50. So it was an incredible deal in terms of oil. And I thought oil was going to bounce back very quick. So it was more of a play on the commodity. And I didn't think we were in a recession. It wasn't like things were slowing down. They stopped the economy and then restarted it. Everything should be kind of in motion still. That's at least the way that I thought. And the oil price got so far to the downside that I thought, my thought is still that we are going to see far higher prices to the upside because they screwed up the supply of oil. And I don't think some of this is going to come back. So it's a very rare opportunity in oil that they presented during that time frame, where I thought oil is going to vastly outperform for the next couple of years. I also saw the alignment of inflation, the expansionary phase of real estate, and all that stuff aligning. And you know what? I'll get into that right now. So what I have here, let me see here. Let me open it up here. The one I want to open is that one right there. And I've got that behind me. It's one that I went over in a couple of interviews that I did. But I'm gonna name or say this. All right, ratios tell us where money has flowed and where it has flown from. Whatever's cheap means that money left that sector. Anything that's incredibly expensive means that money has flown into that sector. That's how the ratios become, we'll call it, out of balance. When things become out of balance, they did it for a reason. And what I'm looking at is I'm not looking at technical charts. I'm not using the technicals necessarily as the sole reason to buy or sell something. What I'm looking at is remember, technical analysis is the culmination of a bunch of human beings interacting with each other. What I want to know, or what I want to figure out, is what is causing the herd, the interaction of humans, to make certain decisions. Why does money flow one way versus another? And what market conditions causes that flow of money? Because the flow of money, the money flow, is what raises or lowers prices of assets. That's it. Earnings per share does not increase the price of a stock. Money flow does. Now, earnings per share can maybe direct money flow into that stock, but you can earn lots of money in a very poor market condition environment. Let's say a stock is making a good amount of money, but it comes into a market condition force, which is a huge headwind for it. So let's say it's an inflationary environment, their input costs are rising, and their earnings start to come under pressure. Or maybe that the interest rates are going up and people aren't willing to flow money into that company, and they'd rather take a risk-free return from treasury bonds at a higher interest rate. So what that means is that money is being guided differently based off of market conditions. And what I've done for the thesis is I've looked at those market conditions and said, this is most likely the reason why the herd is acting the way they are. And the herd is usually pretty slow. It's not quick. It's not like you're scrolling through Twitter or Facebook or something and you get this instant feedback. It's very slow. So things don't move as fast as what most people think. Time frames are not, the time frame of people is not aligned with what the market does. The market is super slow. It's like the Titanic moving around in the ocean. And if you can't move very fast, you could potentially hit an iceberg. There's all sorts of stuff that can happen. But I just wanted to touch on this. What we have now, and I just have some charts behind me. I don't know how in depth I'll get into it, but what I have here is the real estate starts, and we can see the real estate cycle. The real estate cycle, I'm just going to do a brief overview. This real estate cycle, whenever it's in the green, is an inflationary period, and we usually have rising interest rates. We are entering that period right now of an expansion phase. So these green areas are expansion phases of real estate. And whenever you have an alignment of the valuations of the commodity to stock ratio cheap at the beginning of that expansion phase of real estate, which is this alignment here, and we're really low right now, we're really low for commodities. When we hit the inflationary period, and what we have below this, I'll try to explain it. The M2 money supply goes up and down. The M2 money supply is really just your housing starts going up and down. It means that when you build new homes and you get new loans, your M2 money supply increases. And then inflation ensues about a few years after. It's just lagged behind it some. And we're going into an expansionary phase, and we haven't really gone we'll say really high in the home builds yet. That's what I'm waiting for, which will create more M2 money supply. It'll be more inflationary, but they already dumped a bunch of money into the system, as you can see on the right-hand side here. So we should see a response in inflation to that money supply increase. And they're just going to lie about it. I mean, that's what the governments do. They lie about the CPI numbers. They call it a CP lie. Now, we've got the CRB index to S&P 500. We broke the big long downtrend. We broke the secondary downtrend here. And we're in an uptrend, meaning that commodities are outperforming the S&P 500 for this ratio. It's already in motion. I've got the age group here, and I've got the gold to monetary base ratio. And all this is gold accounting for the money supply, and it does it under expansionary phases of real estate, which are inflationary, and money rotates from bonds and stocks into gold and accounts for the monetary base. I think we're going to see another big move if interest rates get to a critical level where people start rotating money massively. I still think this will go up, but I just don't know how big it will go. This is the 2000 to 2008 boom in gold, accounting for the money supply here. But this was also in a, we'll call it more of an environment that I don't think is as strong as today. The demographics weren't as strong. But now we have stronger demographics. We could have stronger inflation, and we'll see what happens. I don't want to project too much. Now, one thing I want to talk about, and I've looked through the comment section, and some people were saying this guy says that commodities are going to be in a deflation. When the herd interacts with each other, all these humans, they create patterns. And these patterns, if you look from a big picture view, kind of like this gold to monetary base right next to me, these patterns, they develop and then they break. They break for a reason. The herd is interacting. These humans are interacting with each other, creating these patterns. And when you break that, it means something. It's a big structural shift in the markets. This isn't like it doesn't mean anything. You don't set up a structure and break it for no reason. You set it up, you break it, and then you run. It's like building a house that would never be lived in. You build the house to live in it. You build this structure to break it and move higher. And that's where I get a little confused with some of these people who are, self-proclaimed experts in their fields, because like if you look at this CRB to S&P 500 here, I mean, this is a huge structural break. We were coming in a downtrend for many, many years, and a ratio, I mean, it's not going to go to zero. You can't have commodities go to zero. It's impossible. We break the structural downtrend move, and we broke this other high, which means we're in a new uptrend for commodities outperforming the S&P 500. It doesn't mean that we're going to go straight higher. It doesn't mean that we couldn't pull back for a little while. But it does mean that the structure is broken, that we are going to head higher eventually. The underlying fundamentals of the market is painting that picture. Now, the more pictures you take and the more you combine them together, the stronger that outlook becomes. So, for instance, you could look at the dollar, and the dollar broke to the downside of its pattern. The 10-year rates, and we'll see if they break, they've been in a 40-year decline. There they are right behind me. I've got the gold price and 10-year Treasury bond here. They've been in this big downtrend line for 40 years, and this is what everybody understands and knows, and everybody thinks that this is just going to continue to go down, and maybe it will. But what if it doesn't? What if it tried breaking out like it did in 2018? Then they did a bunch of QE again and tried driving it down, and that's probably what they're going to do. But now we've got the floodgates open of the money coming into the system from real estate, the expansionary phase and the millennials. Now, when that floodgate opens up, you're going to get a bunch of money in the system on top of what they already printed. It's going to be pretty inflationary. How are they going to slow that inflation down? Well, if they keep interest rates low, you're going to get a huge real negative rate, which means inflation's greater than the interest rate. No one's going to buy bonds. They're going to have to buy every single bond that is created. They're going to have a mess on their hands, and the dollar is going to get absolutely slaughtered, I think, if they go that route. But it looks like it's trying to break to the upside here. That's what it looks like to me. For the 10-year, and we're right, if you draw a line across this way, we're right there trying to break out. Also, I've got some slides here. This is the gold to oil ratio. When you're an investor and you're looking at all these things, all you can really do is if you're going to have the best alignment for an investment, is you've got an undervalued commodity that you're buying. You have an undervalued or cheap company that you're buying. And then you're seeing the market conditions become ripe for those valuations to change. And that's about all you can do. You're never going to have a for sure bet win. It just doesn't work like that in investing. All you can do is you have everything align. And if they all align, that's the go time. Because that's a time that, historically, these revalue against each other. So we had that alignment with oil back in 2020, where it went all the way up into this anomaly area where oil was far cheap. And this goes all the way back to 1950. Anything above 30 is a really good deal on oil. And we were up here at over 50. We went all the way up to 90, and I think it went over 100 for some days. But anything in this area up here was an anomaly in history. And what I did is I bought the living heck out of the oil companies. Then it's been compressing all the way down, and I think we'll probably go somewhere to where the star is in terms of how far we're going to compress, and then we're going to have to break through this trend line through here. Now you look at crude oil, the actual price itself of crude oil. Here's the pattern it created. This created a massive pattern that we just broke to the upside here. The projected move is 160, 170, something like that, a barrel. On this chart, on a linear chart. Logarithmic, it's far higher. It's probably more like $300 or $400 or something like that. Will it get there? I don't know. These aren't price projections. I'm just telling you that chart right there created that massive pattern, and we broke it to the upside for a reason. It didn't just do it out of sheer, luck. There's a reason the CRB index is breaking out against the S&P 500. There's a reason this crude oil is breaking out to the upside of this large pattern the way it is. There's a reason that the XAU to gold ratio is down in no man's land, so cheap, and it's just breaking out to the upside. which means it's about gold and silver outperformance time is what it means. We've got gold over here. This is a massive chart pattern here. It's a big flag pattern. We're up over 1800 now, so we're up at the top of this line almost, because this is a little bit old. And we're about to break this big old pattern to the upside for gold. There's a reason this pattern's developed, and we're about to break it. There's a reason that we're breaking this downtrend line, now moving into an uptrend for XAU to gold ratio. There's a reason that this crude oil chart is being broken to the upside, and that we're compressing oil against gold, which is a commodity bull market. I also have platinum here. Here's platinum in the upper left. Big consolidation. Big consolidation here. We broke to the upside and we ran. We have another large consolidation that we just broke in platinum. Here's natural gas. Natural gas in this pattern here in the channel. We broke to the upside. Maybe we do a retest. Maybe we just go sideways and move on up. But it broke its channel. Uranium. Uranium's moving on up. Here's the price of uranium in dollars. It's moving on up quite dramatically. Down descending wedge pattern, broke to the upside, and now we're breaking this channel to the upside again. And in terms of gold, we're moving to the upside, and you could draw a trend line through here, and we broke that as well. Now, my question to everyone is, and I know you guys listen to a bunch of YouTube channels and other clips, and you're trying to get data, is when you look at these charts and these people are interacting with each other and creating these patterns, the likelihood of these all being wrong is probably close to zero. There's like no chance, because there's too much data here. There's too many of the commodities breaking to the upside all at the same time. So I can't, to me, I haven't seen a stronger, I'll call it more data supporting something than this. I mean, the only thing that we have going in the opposite direction is the dollar right now. And I think that's going to be short-lived. I don't see a scenario where the dollar goes massively up. But again, the dollar index is a currency against a basket of other currencies. And this is happening in all of the currencies. And I don't know if we've seen that as well. Now, that would be a stronger case for a massive commodities bull market. Probably the biggest that we'll ever see if the entire world is all engaged in highly inflationary money printing, pressures. We have real estate markets all over the world doing very well, which is very inflationary all at the same time. So it's possible that the index does go up and that all of these just go crazy. Very possible. But of all these charts here, everything looks good in commodities. I can't find something where I see this huge problem. Now, there are certain commodities that have done very well, where they've broken their pattern, they've broken and run, and then they came back to do a retest. Lumber is one of them. We could say like iron ore is another one. We could have some problems in the short term that shift these things around a little bit. I don't think it means that the commodity bull market is over. I think it's something that we have to look at and monitor, but I don't think everything's intact. And if we have energy prices going through the roof, which we do, I think it's going to infiltrate its way all through everything. And you're going to see it in CPI numbers and all these other numbers that most everyone looks at. So my strategy has been to buy and hold these undervalued assets in a way that I'm diversified across a bunch of them. I'm not all in one sector. I have uranium, I have oil and natural gas. I have copper, nickel, tin, platinum, silver, the precious metals, royalty companies, all those. They're all kind of mixed around. I do think that stocks are highly overpriced and overvalued in relationship to history against any asset. That money, all of this QE and all these stimulus and all this junk that they've created, it's flown into bonds and stocks. over this past 10 years, 10 plus years, since 2009. All that money is going to rotate back and come out, I think, if interest rates go up. That'll be a huge rotation of money. It may rotate even if the real negative rate just gets massive. So money may rotate either way. So that's what I'm waiting for. That's what's going to basically cause all of this money to rotate, is higher interest rates or the real estate expansionary phase, that inflation. That inflation is going to cause that rotation of money to come over. I just don't know what the interest rates are going to look like. And that's what I'm watching. I'm watching that 10-year yield constantly. So watch some of the technical analysis clips that I do. That's most of those companies I cover are the ones that I own. And that I'm just basically going over all the ones that I think are good picks. A lot of them are highly volatile. If you don't like the volatility, I would choose something that's a little bit larger company. That's what I recommend. And if you don't believe in this thesis, or if you think that I'm wrong in something, then I wouldn't participate in it. It's as simple as that. I'm not here to try to sell you guys on anything. I'm here to get you data, get you my interpretation of the data, and then you guys can determine what you guys want to do. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thanks for listening. This is Finding Value.